Good afternoon. This is Brent Eulenhop with Simplify Asset Management. I want to thank everyone for joining us for today's episode of Keeping It Simple titled Passive Aggressive. Another one cites the dust. We'll be discussing the yield curve as well as passive investing dominance. As always, I'm joined by my esteemed colleagues Harley Bassman and Mike Green at Simplify. We're privileged today to have special guest Campbell Harvey. Campbell Harvey is a professor of finance at Duke University and research associate at the National Bureau of Economic Research in Cambridge, Massachusetts. He served as editor of the Journal of Finance from 2006 to 2012 and as the 2016 president of the American Finance Association. He holds a PhD in finance from the University of Chicago. For the past 9 years, Professor Harvey has taught Innovation and Crypto Ventures, a course that focuses on the mechanics and applications of blockchain technology and Web3. He also offers a certificate in decentralized finance on Coursera and also teaches the advanced elective global asset allocation and stock selection, which focuses on systematic investment strategies. So it should be a very relevant and timely conversation today. Two housekeeping items. As always, the chat feature has been disabled, so you can ask any questions to the speakers in the Q&A function at the bottom of your screen. We'll try to get to those throughout the discussion today. And as always, everything covered is for educational and entertainment purposes and should not be considered investment advice. With that being said, Mike, over to you.
All right, fantastic. Brent, thank you for the introduction. Campbell, thank you for joining us again. Harley, it's good to see you, man. It's been a while.
Thank you.
Listen, I wanted to do something a little bit different today. Unfortunately, we fall on the anniversary of 9/11, and particularly in the context of the political violence that's happened in the last year or in the last few days, I wanted to suggest that we just take a moment of silence. Remember colleagues that we lost, individuals that we've lost, political violence on both sides of the party in the past year or so, and hope that we can all have a better year ahead. So if we could just take one moment of silence, I would appreciate that. Okay. One of the things that's interesting to me about silence is how difficult it is to start and then how enveloping it becomes as you go through it. I could have stayed in that for a very long time, but that would have lost me the opportunity to talk to one of my favorite professors out there, Cam Harvey. Great to have you back.
Thank you for inviting me again. I'm surprised after last
You're
time.
surprised. Why? Why would you be surprised after the last time?
Well, it was pretty aggressive, the interchange between us.
Oh, well, that's actually okay. From my perspective, that's just being friendly. You need to
Okay.
remember that Harley and I like to joke back and forth. He's like wrong about almost everything, and I'm gently willing to admit that he's occasionally right on stuff. So, but in the case of in the case of last time, actually, this is actually a really great opportunity. So last time we had you on was primarily to discuss components of the yield curve, and you, among many others, I think somewhat correctly, although I think there is some debate about the data, and I'd like to discuss a little bit of that, but had said maybe it's not going to work this time, right? This is not the same environment, and that actually turned out to be quite prescient. And so maybe that's a good place for us to start by kind of recapping your view that the yield curve last time around meant something different.
Yeah, so the model this is like my model. It's my dissertation at the University of Chicago, and I had limited data at Chicago. Inverted yield curves seemed to precede 4 recessions. Out of sample, it worked really well. So out of sample, it got 8, well, total in sample and out of sample, 8 out of 8 without a false signal. And then we go into the most recent episode where we get an inversion for an extended period of time. But looking at the economic fundamental data, it wasn't so clear. So given that this indicator is such a simple indicator. It's like one variable. And I know the yield curve captures a lot of information, but it's just a single piece of information. And we also know that every time is different. So is the yield curve a useful indicator for expected real GDP growth and consumption growth? Definitely. And even if it delivered a false signal, and frankly, I've not declared a false signal for the most recent episode because it is so complicated. But even if the most recent episode is a false signal, well, that's 8 out of 9. And
Yeah.
and in terms of like forecasting, that's pretty good. So it's not like let's move on.
It is really good, obviously. And as I alluded to in our conversation leading in, I ultimately think it's going to turn out that it was right. I think there's been a number of changes in the way that we measure GDP and the way that we measure employment that we're now finding out, of course, it was severely overstated, et cetera. My hunch is once we're through all the revisions and understanding of what we've changed, we're probably going to conclude that there was actually a recession, or the one that we're facing or could face could be potentially quite a bit more serious because of the delays associated with it. The very clear argument is the difference in the private sector versus the public sector. I think most would argue that at least 2/3 of the private sector certainly experienced recession-like conditions, even if it didn't necessarily come through in the aggregate, largely because of the stimulus that was happening on the public side. But with that said, let's actually flip to our audience and let them answer the question. So we've got a poll on the yield curve. So the 3-month versus 10-year inverted in November of 2022 and uninverted in December 2024. The uninversion is actually a really critical one, and it's one that I think both Cam and I emphasized last time, which is it's the uninversion, particularly if it's driven by a flattening of the yield curve. I'm sorry, a bull steepening of the yield curve that tends to actually really be coincident with the recession. We uninverted in December of 2024. Will this recession indicator be right again with the recession by May 2026? Yes or no question. Let's see how our audience thinks.
I think you're allowed to go and start the clock when the uninversion happens. That you have 18 months after that. So that's where we got the question from.
Well, we've got the expert here. So Cam, what's your take on that?
Again, we don't know exactly what the rule is. And the 18 months is just the historical experience. So you could go outside of history. So maybe it's 19, maybe it's 20. It's really hard to say, but given the historical 8 observations, and that's not a lot of data to make decisions upon, that's what we kind of expect. But you make an excellent point on labor. And it's also the case that given the growth of the government sector, number one, and that leads to consumption that is relatively insensitive to economic shocks. And on top of this, that you've got a group of consumers at the very high end of the income distribution where it just doesn't matter what's happening in the economy. It doesn't matter if inflation's 25% versus 2%. They don't even look at the price. They just buy. So you get that insensitivity at the high end. You combine it with government. And again, it really forces you to think about what is a recession. So we measure it as like overall in the economy. But if you look at it in terms of the actual population for the people that are taking a hit already, many people are in recession right now.
Well, if we use 48 months, Mike, as a window, then we can say your rate call's been right.
Oh, 100%, Harley. This is really the objective of getting Cam back on here, is to give me the opportunity to claim victory against market forces. Now, Cam, you bring up, first of all, I absolutely love what you just said there at the end, because that is actually an area that I've been hitting on as well. This concept of the K-shaped economy. I might even go a step further and note that for many of those that are at the top end of the cycle of the wealth spectrum, hiking interest rates has actually provided an unanticipated benefit. The copious quantities of cash or resources that they have are now suddenly earning significant excess returns. my analysis suggests that one of the perverse consequences is if the Fed is forced to cut because of economic weakness, it will simultaneously be pulling income support from that cohort at the same time that that interest rate cut, if it's due to credit deterioration, is unlikely to flow through to the lower end. And so this is going to be the question for our time. We don't know this. And I also love the fact that you introduced it in the context of, look, guys, we've got 9 examples here, right? The 9th one we don't even know yet. I often cite this to people. We look at stocks, we say that they have, 9% returns or 10% returns over history. That history is give or take 100 years in the best markets. Out of roughly 100,000 years as anatomically modern species, we know very little about what we're talking about. And so with that as a good lead in, Cam, let's talk about what we know about efficient markets and indexing. You have, as the title of the piece suggests, and I want to give you full credit for this, largely independently have come to basically the exact same place where I have come, which is passive is not in the least passive. It has become an extraordinarily distortive force in the US equity markets.
Yeah, definitely. So the piece is called Passive Aggressive and is co-authored with Chris Brightman. And what it does is it really challenges you to think about what passive actually means in terms of an investment strategy. And Mike, I know you've written on this, and indeed our paper cites your work. So I think that we're fairly aligned on this. And let me give the basic intuition. So I kind of go back to one of the most important academic papers that has ever been published, and that is Bill Sharp's Capital Asset Pricing Model, 1964. And the implication of his model is that risk should be defined as a stock's contribution to the risk of a well-diversified portfolio. And that builds on Markowitz's work. But the implication, the key implication of Sharp's work is that people should hold the market portfolio. And depending upon your risk tolerance, that's either mixed with fixed income or you're levered up, you're borrowing to invest in this single portfolio. So this is really the key implication, and it's really important to understand the assumptions behind this implication. So
Cam, let me pause you for 1 second there, because I just want to
Yeah.
make sure that our audience catches up to exactly what you're saying. So Sharp's work, as you point out, is an extension of Markowitz. What he was highlighting is if we define risk as volatility, or more accurately variance, right? If we define risk as that, then the contribution that any single is going to make to the aggregate portfolio risk is going to be a function of its relative market capitalization.
Yeah, so let me
Covariance factors associated with it.
Yeah.
Did I
Yeah.
break up there? I'm sorry.
Yeah, you broke up a little bit, so let me rephrase it a little bit. So,
Okay.
so the idea is that you might have an asset that's got a lot of volatility. That's not the risk, unless you just hold naked one asset.
Mm-hmm.
And people just don't do that. So the way to think about risk is you've got a portfolio that you start with. And then when you add an asset to the portfolio, what does it do to the risk of the overall portfolio? So if it's a hedging asset, it might reduce the overall risk of your portfolio. And it might be another, like anti-hedging asset, which could increase the risk. And what that contribution to the risk, that's what should be rewarded. So people actually like reducing risk. So adding a hedging asset, then that asset should have a low expected return because it provides a service to the portfolio. It reduces the risk. And if you add an asset that increases the riskiness of the portfolio, then that should have a high expected return. So you need to actually be compensated for taking
Yep.
that extra risk. So that's the basic idea, but there's something else. And this is really important. So the implication is there's one portfolio, the market portfolio. People ran with that. And now we've got passive being 53% of all investment. So it has recently overtaken active investing. But you need to dig down as to what the key assumptions are in terms of the Sharpe framework. And one crucial assumption is that the prices, the stock prices, are exactly the true value of every single company out there at every single moment in time. So there's no misvaluation. It is a strong kind of market efficiency sort of assumption
Absolutely.
that all prices are correct. So let's take that assumption and let's relax it just a little bit. So I'm from the University of Chicago. My dissertation chair is Eugene Fama, the father of the efficient market, hypothesis theory. And people mistakenly believe that, oh, you're from Chicago, that means you believe that markets are efficient. And that's a misread of his research. So efficiency is a relative concept. And nobody believes that markets are 100% efficient. We do believe that the stock market in the US is relatively more efficient than the stock market in Zimbabwe.
Mm-hmm.
So we can say that. And the US is also the most efficient market in the world. But let's do the following thought experiment. Let's suppose that we're close to complete efficiency. We're only off by 1%. So some stocks are 1% overvalued, some stocks are 1% undervalued. So we're close. So what does that do in a passive portfolio? So that's the key question. So in a passive portfolio, by construction, you are investing, your investment weights are determined by the market capitalization of stocks. So mechanically, you will be overweighting overvalued stocks and underweighting undervalued stocks. And that induces a drag. Now, I don't even need to identify what stocks are overvalued or undervalued. Is just a mechanical relation that by construction, cap weighting means that you are overinvesting in overvalued stocks, underinvesting in undervalued stocks. And that's the drag of passive investing. It's nowhere in Sharpe's model, which is a very elegant model. I'm not criticizing it at all. What I am criticizing is taking a theoretical model and not scrutinizing the assumptions. And the assumptions are driving the result that you should just invest in a passive portfolio. So
Why is a bigger company rich relative to its valuation? That doesn't make sense at all.
No, it's not, Harley. Let me try to make sure I interpret Cam's point just so we can get this one nailed down. He's actually not saying that every big company is overvalued in this scenario. He's just saying that from a statistical scenario, a company that is overvalued is going to be overweight in a market cap weighted portfolio.
yeah,
And therefore, statistically, you end up in that. It's not every single company. It's just on an overall framework property that just falls out of the map.
Yeah, but of course, it's more serious if you've got a company that is large
Correct.
in terms of the overvaluation. And the example I like to give is this company called Strategy, which you might have talked about before, but it is, I've written about them on LinkedIn, my LinkedIn post last month. The Strategy is such a simple company to value. So one of my colleagues was teaching the intro finance course today, and they were going to do discounted present value and stuff. And I said, no, start with Strategy because it's so easy to value because they've got one asset, and that's all these Bitcoin that they hold. And we got a price for Bitcoin. They got a little bit of debt. So it's almost immediate that you get the value the net asset value. So the net asset value is at odds with the stock price. And this is not a 1% over or undervaluation. When I wrote my piece, the stock price was 90% overvalued. So
How do you know
and
what
that's
values,
remarkable.
though? I mean, that seems crazy. You're telling me that Oracle was 40% undervalued on Monday and no one
And
knew it?
So again, this is much more difficult to actually come up with a value of Oracle because it depends upon expected future cash flows. Strategy is super easy. So the ratio of the stock price to the net asset value has dropped. It's now like 1.5. So it's 50% overvalued. So you don't need to do any discounted cash flows. You just look at their asset. It's got a market price. And and this is a massive overvaluation. So it's not 1%, it's 50% today, or 47%. I checked a little earlier. So think about this. This is one stock. It recently didn't make it into the S&P 500. Its market capitalization is about $100 billion. So there's only 20% of stocks in the S&P 500 that have capitalization more than 100. So 80% of the stocks have a capitalization less. They've refused this particular security. Indeed, if you look at a $10 billion cutoff of market capitalization, and just to be clear to the readers, market capitalization is the stock price times the number of shares. It's the total value of the equity out there. So there are like 25 names in the S&P 500 that have a capitalization of less than 10 billion. And this is 100 billion. But if you are like Russell 1000 or broad market index, using passive investment, it is completely irrelevant that this stock is overvalued by 50%. You don't look at any fundamental data. You just look at the stock price. That's the only thing, the stock price. You invest.
Which is part of the great irony, of course. And this is one of the reasons why I get into, let's say, discussions with individuals who are so supportive of John Bogle's views. He is well quoted for saying you have to ignore price, right? But the irony is that passive investing treats price as the single most important.
Yeah, so
actual variable that you care most about. All right.
Yeah,
You're pretty good, Mike.
Yeah,
Oh,
you're
Cam, by
faded
the way-
out, but let me continue. Let me continue that thought. So yeah, it is there's a school of thought. Indeed, Rob Arnott, 20 years ago, published this very important paper detailing the drag that's induced by using price. And Bogle, same sort of philosophy that you need to use fundamental information. So instead of looking at price, which could be over or undervalued, you look at other information. So you can imagine weighting by like revenue rather than price. So there's plenty of alternatives in terms of cap weighting, but what we've seen is people go to cap weighting. So again, 53%. And that means that you ignore all fundamental information. Now, let me say something that's important, and that is that that the alternative is active, and active has underperformed. So active has got like two negatives. Number one, the overall performance on average is below passive. And then number two, the fees are higher, which is part of the first issue. I would be careful here because that's the average. And there's a lot of active investors that are not very skilled. But the alternative is active, and active actually does look at fundamental information. So,
well,
Mike,
Cam, Can you hear me now? Because I do want to make
Yes.
sure that we actually stay on a couple of these points. First, you came at this from a very critical point. You basically highlighted that the cap M formulation and the idea of market cap weighting presumes a level of efficiency that is absolutely absurd. Just sharing a chart that's from my deck, the contribution that I would argue that has been added since 2004, 2005 was really brought by Lasse Peterson at AQR, since we brought up Rob Arnott. We should probably do the exact same thing, in which he highlighted that Sharpe had another error or critical assumption. Let me be very more precise on that, in his paper, The Arithmetic of Active Management, which is the process of getting into and out of a market and what a passive investor is. And so under Sharpe's definition, a passive investor always holds every security from the market. An active investor is one who is not passive. In other words, there is no mechanism for a passive investor to get into the market or to get out of the market. Now, Lasse's observation on this was that during periods of index reconstitution, that forces a change in portfolios. It forces active managers to trade, and therefore they become active managers, and they are no longer subject to the outperformance characteristics of Sharpe. My contribution has primarily been a slight modification of that, which is to recognize that every time an investor adds cash to a fund or takes cash away, they're not changing the market portfolio or the presumed market portfolio, but they are changing the portfolio of the passive fund. And so they also are forcing trading activity. That means that a passive fund is never passive. It can never be passive. And so to your point, when you're talking about drag, I just want to be very clear, because this is one of the really critical mistakes that people make in this. We can talk about whether active managers underperform or outperform, but the first thing to recognize is all managers are active. And so what we're actually doing is we're saying, is a market cap weighted portfolio, does it experience drag or outperformance versus other strategies? And I think the point that you and I would both come to at this stage is to say, when you put your thumb on the scale as a policymaker and you decide that you are going to liability protect and direct flows in a wide variety of ways into that market cap weighted portfolio of active manager strategy, what you're actually doing is recreating the effects of J.P. Bouchaud's recent paper, Ponzi Funds. He wasn't the lead author, I forget. I think it's Philippe, I'm forgetting his last name, who wrote the paper Ponzi Funds, in which the distortions that are caused by the flows into the vehicle itself create the illusion of performance. And so this is actually the critical slide from my presentation that hits on this, which is when we talk about alpha, another Sharpe creation, right? What we're actually doing is describing a linear equation. The alpha in a portfolio is simply the intercept in a y equals mx plus b equation. And if you distort what you perceive as the market and create a continuous rising valuation that is created by the flow of funds into these claimed passive but actually active funds, you cause returns to rise. That causes the intercepts mechanically to fall over time for active managers, right? For other strategies. And so perversely, you say drag, and most people hear them say, well, that means they should beat the passive market index. But actually that drag is causing the underperformance of the active managers. And so you and I think, ultimately see the same underlying phenomenon. You've highlighted the cyclicality of active outperformance in your paper. My point is very much that what we actually seen is an extended cycle driven by passive growth that causes the alphas to get more and more negative, creating more and more incentive and regulatory frameworks to drive money into passive vehicles. And I call it very simply the active manager killing machine.
Yeah. So there's so much here. So we just scratched the surface on like one of the assumptions that Sharpe makes.
Yep.
And I do want to make it very clear that there's no mistake in Sharpe's paper. it is,
Y-
the paper is correct based upon the assumptions. The model is incredibly useful and impactful, but with any model, when we apply that model to the real world, we need to scrutinize the assumptions to make sure that we're doing the right thing. And we've gone through one example where if there's any mispricing in the market, then the implication of the model is problematic to hold a passive market portfolio. So another part is, well, what is the market portfolio? And researchers have struggled with this over years. So the S&P 500 is not the market. It is a subset of the market. It's like a growth portfolio. So we need to be careful of that. And what Sharpe had in mind was the total market portfolio. But this was a static concept where, as you correctly point out, there's stocks that enter and stocks that depart. And that creates a dynamic. Yeah, this idea of passive and active is so poorly understood. Another example of this is, oh, well, I'll hold a passive 60-40 portfolio, equity and fixed income. Well, no, that's not passive. That's active. Because if you go, if the equity market drops and you go 55-45, then you're buying, right? So as stock prices go down, you're actively buying. So the rebalancing is an active strategy, and it's a value-oriented strategy. So this is, we talk about really basic things that we think that people fully understand, like portfolio diversification, active, passive, rebalancing, risk. All of these things people think they understand, but when you dig deeper, it's way more complex. And for me, to design an optimal strategy for any investor, you need to understand these basic concepts. And I'm afraid to say that we fall short in our profession, both of communicating as educators and advisors to investors. So there's a lot to learn, and unfortunately, investors pay the price.
Hey, Cam,
That
I
is,
went to U Chicago also, I think before you did, and I had Hamada as opposed to Fama. And they start the course, 332 with the markets are efficient. And then, by the way, here's 14 reasons why it's not. And they go through all of those. And aren't you just basically kind of describing the 14 things like in over 300 pages in a book?
Yeah. So,
I think
so
efficient
yeah,
markets is more of a straw man to describe all the efficiencies, taxes, bid offer, all the other various things here.
yeah. So the course that you took, I taught at the University of Chicago, 332, when I was visiting a professor there. And certainly I had many great interactions with Bob Hamada. Yeah, so this is kind of consistent with our conversation. So you start with a baseline, and the baseline is, well, suppose the market's efficient. And that's kind of where we start at the University of Chicago. And then that's kind of a hypothesis. And then we find some evidence that it's not. And you mentioned 14. It's much more than that today in terms of things. And then what can we learn about that to improve our investment framework? So that's the idea. So you start with the straw man almost, and then when you show deviations, then you kind of learn from that and enhance the model. So let me give you an example of a model enhancement. So, and I did this many years ago. In the Sharpe and Markowitz context, all that matters is the risk of the portfolio and the security contribution to the risk. And that risk is variance. So this is another assumption in both Sharpe and Markowitz, that investors only care about variance. And variance or volatility is a measure that is not a complete measure, because negative returns and positive returns are treated symmetrically. And investors have a strong preference for a big upside and a strong preference against a big downside. So what we can do is to add kind of a downside measure of risk to enhance the Sharpe model, to take it to another dimension. So I've got a preference for a security that adds a lot of upside to my portfolio. And I really don't like these securities that add a big downside to my portfolio. So it adds another dimension. So again, the Sharpe model is not wrong. It is correct based upon the assumptions. So what we're talking about is relaxing these assumptions. So relax the assumption that market prices are always 100% correct all the time. Relax the assumption that risk is just the volatility. Because we know that investors have a broader set of preferences. And then what we do is we kind of build out a different framework. And that's where we should be focused in kind of relaxing these assumptions. And there's a long list of them. And indeed, I've written papers, numerous papers, relaxing these assumptions, trying to improve the experience of investors.
Well, I'll tell you,
So-
I think that the passive portfolio, in many respects, is just a strategy to minimize what was the 14, market efficiencies and minimize those costs, which is why active always loses because they tend to do it. And as far as Sharpe goes, I mean, I wrote, it wasn't book length, but I wrote a few papers about Sharpe. I think it's totally bogus because the idea of volatility having a relationship to the value at the end of the day is preposterous. I mean, we had a product where we bought this 7-year option on 20-year rates. I mean, I got vol, I got curve, I got skew, I got these wide bid offers, just wiggling around the bid around fair value because it's a wide bid offer. That's not risk. That's just, I don't know, it's something else, but it has nothing to do with risk.
Yeah, so it really
I mean,
depends on how you think of risk. So
people use volatility
and
as a measure of risk. It's ridiculous.
yeah, so again, I've thought deeply about this. So it really depends also on your time horizon. So this wiggling around in the short term could be completely irrelevant if you're holding this for 5 years. So your investment horizon is very important. So this wiggling around could be tied to illiquidity. Illiquidity is a real source of risk. So if you've got an asset that's illiquid and you need to sell it in a hurry, you're going to take a massive haircut. So to get me to buy that asset, you need to discount the price, which means the expected return is higher. There's going to be a premium associated with this. So risk, in my global asset allocation stock selection course, we spend 4 hours, which is a big chunk of the course, just talking about risk. And there's 20 different dimensions of risk that we talk about. And it's way more complex than volatility. So I'll give you an example. So we say risk is volatility, but maybe we're not sure what the volatility actually is. So we need to measure the volatility. And we know the volatility is changing through time. So there's uncertainty about the measure of risk. That is important. That needs to be taken into account.
Yeah,
Cam and Harley, just hold on for 1 second because we are going to run out of time because what we are literally doing here, I just want to actually orient our audience for a second. If you have never been in a PhD finance course or in an MBA finance course or even an undergrad finance course, you are now sitting through one with one of the world's best finance professors and one of the worst finance students I've ever met. But the simple answer is like, this is the sort of hyper nerdy stuff that the people who really care about this get into. And then it has to be simplified and explained to your mother-in-law. Right. And that is where the breakdown is ultimately happening. Because what Cam and I are both highlighting in the work that we've done around passive is those assumptions don't matter when you're 1% of the market or 2% of the market or 5% of the market. But they really start. My work actually would suggest that it does start to matter pretty early. But I think we'd all agree that somewhere in the 10, 15, 20% range you're probably fine with some of these assumptions. But we've now actually moved to the point where, because of the scale of the flows, because of the scale of the passive representation within the investment universe, this is the equivalent of attempting to do a moon landing with, napkin math, basically. And
Yeah.
it's just not going to work, and it exposes us to extraordinary risks. And so I'd like to just redirect for a second. There's a couple of questions that have been asked. One that actually brought me to making that declaration. One of our listeners, I'm not going to name his name, but he is both a Substack subscriber of mine. He's a regular participant. And he asked, could you provide a link to Professor Harvey's paper? And I said, oh, it's just us on SSRN. His response was, what's SSRN? That's something that we always have to remember. The vast majority of people have no idea what we're talking about, even if they are as interested enough to tune in and listen to us ramble on for nonsense for an extended period of time. So the vast majority of people don't have exposure to it. Let's pause for a second. And Cam, I'd like you to take the lead in maybe describing what are the implications of the assumptions that we've made and what we've done if we look forward and say, what happens next?
Yeah. So thank you for inviting me to do that. And this is really what I do. It's my job. And my job is not just to lecture to my master's and PhD students. I've got over 100,000 students on Coursera, and I do plenty of outreach. So let me actually detail the problems with passive investing, and I think they're pretty intuitive. So the number one problem we've talked about already, that the way that a passive portfolio is put together is based upon the size of the stocks. So if we've got a portfolio that has got like two stocks, one stock is $80 million. If you look at the share price times the number of shares, the other one is $20 million, then that passive portfolio is going to have $80, let's say it's a $100 portfolio, $80 in the larger stock and $20 in the smaller stock, and that's it. So that approach just looks at the value that is being traded. It is possible that $80 million capitalization is overvalued. And I gave an example of a stock that is, in my opinion, grossly overvalued.
But what's wrong with overvaluation?
Well,
that makes
the
us
thing
feel
is
good.
that if there's a correction, then you're going to be a loser. So maybe that stock that I put $80 into, I should have only put 50. And if there is a correction to fair value, and the example of strategy is a good one where I put my LinkedIn post, it was 90% overvalued. Now it's 47% overvalued. Then you're a loser because of that. So buying just based upon price weights leads to the situation that you will buy construction, put too much money in overvalued stocks and too little money in undervalued stocks. If they remain exactly at the overvaluation and undervaluation, then nothing really happens. But there's a strong possibility of some sort of reversion. It might not be 100%, but that means that the investor will be a loser in a passive strategy. That's number one problem. So that's the one that gets the most talk. Secondary, and it's kind of related to this, if the market is dominated by passive investing, and my paper shows that extrapolating the trend, in 10 years, 80% of investment will be passive. So as the passive gets so large, there's very few people that are questioning the fundamental information and making the statement, oh, the stock is overvalued. So there's very little what we call price discovery. And that just means that somebody does the research on the company and says, this doesn't make any sense. It's trading at $200 and we think it's worth 20. So you need people to do that research, to reveal that information, potentially to short that stock and to get it into line to something closer than to the true value. So that's number
Cam,
two issue.
I'll tell you something. From U Chicago to U Chicago, you're gonna have to go take that red pill, get back in the jelly, man. Because if you listen to Mike, which this I do, is that because of the inelasticity of larger versus smaller, Mike can explain that. As long as this passive's going, the bigger get bigger, the smaller get smaller. So values is a meaningless construct right now until everything blows up, which could be years from now. I mean, right, Mike?
Yeah, unfortunately, I mean, there's several things, right? And so there's a reason why I play a professor on TV and Cam gets to on Twitter and Cam gets to actually be a real professor. Part of them is that Cam speaks in very, very measured tones, right? So when Harley was talking earlier about the dynamics of a very complex product that he runs, it might have something to do with interest rate strategies. And the pricing that he sees on that pricing is not actually based on somebody doing an analysis of fundamentals, right? It's based on where transactions are going to occur. And so Cam immediately jumped to the right point of saying, well, what you're really highlighting there is, Harley, is liquidity risk, not anything else, right? And so the market conditions are setting those prices at points at which transactions will happen. Morgan Stanley is competing with Merrill Lynch, Goldman Sachs is competing with Merrill Lynch, and Jane Street is competing with all of them, right? And so what you're ultimately looking at there are conditions that exist within a market. The problem with overvaluation, this was fantastically written about by Michael Jensen in his 2003 paper, The Agency Cost of Overvalued Equities. That overvalued equity is used as a, in the case of strategy, for example, is willingly accepted by underwriters who are happy to write debt instruments because they know that they can short the overvalued security and therefore create the synthetic exposure that allows them to underwrite the paper that is being sold at ridiculous valuations to unsuspecting rubes, right? Those unsuspecting rubes think of that as being significantly less risky than the equity portfolio. Therefore, they're willing to put it within a levered portfolio or allocate a larger fraction of their portfolio to it. And the risks cascade. Management teams seeing their stock as overvalued interpret it as, I'm a genius. Guess what I'm going to do? I'm going to build data centers all over the place to take advantage of this fantastic new AI innovation. The people working at the data centers aren't doing the analysis that Cam was describing, saying, is there actually a future return associated with AI? And therefore, they're blindsided when the stock market corrects on the overvaluation and they lose their jobs, right? This is why it matters. And this is why it is so dangerous when regulators step in and put their thumb on the scale in the manner that they have done to try to drive the behavior that we're seeing under the rubric of this is the smart thing to do. I'll get off my soapbox now, but that is absolutely where we need to focus.
Yeah. So I will say that very little has changed in 100 years. So if you think about the genesis of 1933 Securities Act, where people being taken advantage in the late 1920s, misled, the goal of just maximizing profit without thinking about the long-term implications in terms of reputation. This is the genesis of the Act of 1933, and so little has changed. So I agree with your examples. There are two other drawbacks of passive investing. Can I mention those?
Yes, please. Absolutely.
So number one, there's actually three. Let me do the first one quickly, and because we talked about it. The academic research has shown that as a result of the passive investing, stocks become less liquid. Okay, so and less liquidity.
Well, we didn't need an oracle for that, did we?
Yeah,
Cam?
well, I just want to put that out.
No, I'm joking about the stock oracle and its price reaction the past couple of days. If you've not seen this, oracle has soared basically double.
I've definitely seen it. So my room is not really in the ivory tower. So the second issue is kind of interesting. And that is that when you've got these massive funds that are doing passive, when flows come in, they put an order out to buy everything.
Yep.
And when you buy everything, that means you increase the correlation between the different stocks. So the stocks are moving kind of lockstep. And what this does is it decreases diversification, and it also leads to a potential systemic risk. So if there is a large correction, then there's a massive sell order of everything. So this is, so the more passive, the higher the correlation, the lower the diversification benefit, and higher systemic risk. So that's number two. And then number three, and this is very interesting, there's some academic research on it. So you've got these giant companies that have investments, large investments in large companies that are competing against each other. So it's almost like you have a common owner. So company A, it has got like a strategy to take a piece out of company B, and it's going to really punish company B. But if I'm the owner of company A and company B, then it's not so clear that I want company A to attack company B. So this actually reduces competition, which is not a good thing in terms of the economics. So we want actually the company that has got the best chance of creating value for shareholders to succeed. And we do not want constraints on how they actually do that in terms of the competition with the firms in their same sector. So you put all this together and you've got a lot of negatives.
Cam, you hit on this last point. This is one that I'm increasingly writing about as well, which is this idea of the impact of consumer surplus versus producer surplus. It's created by the concentration or co-ownership component. Do you remember the paper that cites that? I'm blanking on it, but the evidence is that over the past decade, roughly $3 trillion of value has shifted from consumers to the corporate sector because of passive, excessive levels of passive over ownership and co-ownership, the failure to basically enforce competition. What do you remember which paper that is?
I do not, but we
Okay,
can
I'll reach
post
out to
it
you
on the
afterwards. I'll share
website.
this stuff.
Yeah.
Yeah, I'll make sure that that's available to our listeners. But this is some of the stuff that I've been working on a lot as well. This is all right. As you can tell, I get up on a soapbox on this. This is very, very straightforward. It is something I feel very, very passionate about. It is an area of real concern. Let me ask the question that everybody always asks me, Cam. I know that through your affiliation with research affiliates that you regularly develop and work to develop products that can take advantage of this. One of those insights has been things like the fundamental indices, which I know you've worked with Rob Arnott on. The challenge is, while those are great ideas and they will ultimately reduce the risk, there's still just an extraordinary exposure to this passive factor and the overvaluation and the corporate behaviors and all the other stuff that you were talking about and identifying. Is there a solution? Is there a safe answer for people at this point, given where we are and in that transition potentially from 53% to 80%, which by the way, I don't think we'll actually get to because the volatility that implies is so high.
Yeah. So can I share like a slide?
Absolutely.
Not even a slide. Yeah. Can you see this?
You've started screen sharing on my, yes, I got it.
You got it?
I got it. Can you zoom
Okay.
in a little bit though? Because I know it's small on my screen at least.
Okay. Let me just zoom in a little bit.
That's
Yeah.
pretty good.
So this is something that I'm embarrassed to say I didn't know. And that is that if you take the Russell 1000 value and you equal weight with the Russell 1000 growth, then you get the Russell 1000 exactly. So what's not in value is in growth. And this modern growth value on the left-hand side kind of illustrates Russell. It doesn't really matter what. So you've got certain stocks in one category here, I've got growth, and it's just like sales growth. And then the other category, I've got cheapness, which is just book to price. So the way it works is that in these indices, you've got all of the stocks in the Russell 1000 represented. So you've got in the value, you've got the value stocks, and you've got some other stocks on the edge, which are in brown. And then in the growth, you've got what's in pink and the stocks in the brown area. Everything is held. Every single stock is held. So why not do something incredibly simple? And that's on the right-hand side. And this is a recent paper of mine called Fundamental Growth. And that is, you see that quadrant with no color? These are stocks that that you don't want. They're expensive and they're low growth. So who wants a low growth, expensive stock? So maybe if it's expensive and high growth, it's okay. But the low growth, expensive stocks, you don't want. So why not just invest in the three quadrants that have a color on them? That to me is really simple. So it is not a fancy strategy. It is just exclude these losers from a cap-weighted index. It could be a cap-weighted index and just take those stocks out. And it is something I call active light. You do it once a year. There's minimal turnover of the portfolio, and it is just so intuitive. So this is just kind of like an example of the sort of things that I think about that are simple, low cost, easy to implement, highly intuitive. Like it's really challenging. It's really challenging to answer the question, why should I invest in a passive portfolio in stocks that are expensive and low growth? So I'd be very interested. I've got one answer, one possible answer, and I've investigated it. And that is, well, maybe these stocks somehow are hedging stocks. They're maybe low beta stocks. And it's true right around the edge. There's a little bit of that, but again, it's a minor contribution. And I will tell you that if you look at these different quadrants, the green, the brown, and the pink, they have historically positive excess returns compared to whatever passive benchmark. And that one in the bottom left, the loser quadrant, is got a strong negative return. So again, if you're a passive investor, you're buying everything, every single dot you're investing in.
Well, the argument that you would ultimately make, right, is that those companies are your classic, they will be value traps eventually once the book value has been written off, right? So it's a company that is shrinking and dying and continues to hold things, at least initially continues to hold it on its book value, and then is forced by a terrible kitchen sink quarter to write everything off. The book value disappears, and suddenly you're looking at a company that's not growing and has a very low book to price ratio.
I'd say
That could
book
be
value is
temporary.
meaningless in service economy.
Well, and that's the other argument to it. So, so this is, I've occasionally gotten into arguments with individuals at various firms on these types of topics, right? Do we isolate to book, et cetera? I completely agree with what Cam is really saying, though, which is just, hey, look, a big chunk of investing is about doing what most other people are doing, but just don't make the super obvious, stupid choices that many of them do.
Filter. It is a very light filter. This is not where you're tracking every day. This is super easy to do. I gave a very stylized example where I've got a single measure of growth, which is sales growth, and a single simple measure of value. Right? You could do this in a different way with many different metrics, but this is incredibly simple. You do it once a year and you get rid of those losers. And again, it's active light.
Well, so I want to hit on this because, both of our firms, right? Your affiliation with Research Affiliates, Simplify, we have a number of products that attempt to address some of these issues, hitting on different definitions. Harley mentioned book value. We were working with Andrea Eisenstadt, who I know you've also interacted with several times,
Sure. I know
to
her
offer
work
products
well.
on that.
And we implement what she does also.
Yes, absolutely.
Mhm.
And so we're all basically trying to solve components of this. The really key thing about your work and my work on passive, though, is what you introduced in the language of a non-diversifiable risk, right? This is a systemic risk. So buying 3/4 of the market is still going to expose you to the fact that the market in its totality becomes distinctly, or at least the public equities in markets become distinctly overvalued. That, I think, unfortunately, is the answer that I often highlight for people. There are implications of things that you hit on when you were talking about systematic rebalancing in portfolios. So things like target date funds that sell equities and buy bonds, or buy bonds and sell, or sell bonds and buy equities for rebalancing purposes. Those are overlaying the momentum strategies with value strategies. They themselves become subject to corruption. Right now, I would argue that the changing of interest rate policy so radically has meaningfully affected the structure of the bond index, right? By devaluing duration, raising the relative value of short end bonds, it's led to the conditions in which everyone is convinced that 2.5% real rates for 30 years are somehow terrible and indicative of the collapse of Western society. Those are outcomes from mistakes that are being made in these models. And so those are areas that I would direct people to. Now,
Yeah,
with that said, we have exhausted our time. Cam, last time we got to talk a little bit about tokenization. I would love for you and I to sit down and talk about it, because it's the area that I'm spending a lot of time on now as well. But with that said, what a privilege to have you back. You were 100% right in your, at least so far, in terms of your questioning your own model, which is a very hard thing to do last time you were here.
not
This
hard
time
for me.
around, well, for many it is. And so I just want to emphasize that. This time around, you've brought some really, really interesting thoughts from a firm that is known for its work in quantitative analysis around some of the risks associated with relying too much on simplified quantitative frameworks that are easy to explain in the public. And so I just want to say thank you very much. We're going to hand it over to Brent, wrap it up. And Harley, I look forward to hearing how your grandchild in Pisa is doing.
Hey, excellent job,
Thank you,
gentlemen.
guys.
Thank you so much. Thank you so much again, Professor Harvey, for joining us today. And I want to remind everyone to please register for the next Keeping It Simple on October 2nd, titled Convexity Squared, where Mike and Harley will unpack asymmetry with Noel Smith of Convex Asset Management. We hope to see you next month. Thanks again for joining, and have a good rest of your evening.